of Appleman Properties. Today we are joined with Percy Nicola. Percy is a managing partner at Penn Capital and brings a wealth of experience in investor relations, capital raising, and strategic insights from a career spanning from private equity, real estate, and executive roles in finance and pharma. Percy, we appreciate you coming on the show today. If you could let the listeners know a little bit more about yourself.
Sure, Josh. Thank you, and thanks for having us on the show. So a little bit of background. As you said, I've been in sort of Fortune 500 as well as some startups. I had my own tech startup, sold it, started to look at diversifying my portfolio. Initially, real estate was a small part of that portfolio. And then over time, I just realized that it was giving the best risk-adjusted returns, right? So started to invest more into real estate. Like many folks out there, initially started with single family, had a portfolio of single family rentals. You quickly realize that's very hard to scale. So we started to go into multifamily. And when we started doing multifamily, initially, this is probably in 2011, 2012, started to invest with some other sponsors as an LP. And then over time, we started to see their sort of underwriting assumptions not be as conservative as they once were. So we like to be pretty conservative. So we said, okay, let's try to see if we can find some deals ourselves. So at that same time, some other folks wanted to invest alongside us. So we created Penn Capital almost 8 years ago now to start with that process.
That's fantastic. And you started right there in the era where things were starting to pop out of the '08. So you were able to, I'm sure, identify and secure some fantastic deals along the way.
Yeah, I wish we had a time machine and could go back in time and buy some more properties at the price that we were. Even a few years ago, the prices were not as high, or not as, haven't run up as much as they have recently. And I'm sure we'll touch on this, but that's really what led us to look at some new markets. And we sort of shifted our strategy a couple of years ago because we initially were in larger markets like Houston. And then we saw the cap rates being compressed and the asset prices being increased. In some submarkets, we actually set the record. So we had a portfolio in Houston, and we just kept getting offers from people on selling it, even though we had a 5-year business plan to hold it. So after the first couple of offers, we ultimately took it back to our investors, said, hey, look, this is what we're getting. This meets or exceeds our 5-year projection. Would you like us to take it? And they said yes. So I think it was a little over 2.5 years, or between 2.5 and 3 years. We were able to sell that portfolio, give a nice return to our investors, and we started to look at other markets that were flying below the radar, right, where the asset prices were not as inflated, but still had really good fundamentals. And by that, I mean job growth and population growth, which is the key metrics for multifamily sort of growth. So we identified a couple of markets, Huntsville, Alabama being one of them, that had really good long-term job growth, diverse set of employers, and the average occupancy in that market was about 97%. So we started to invest in that area, and again picked up some great deals. And we've done 7 projects there now. 4 of them have gone full cycle.
That's fantastic. I know compressed cap rates are great if you're the seller, and if you're the buyer, it can be frustrating and tough.
Yep.
You just mentioned something that is really it's kind of like connecting the dots, I guess. How do you all find the path of progress markets? I know you mentioned job growth and population, but
right.
There's emerging markets that come way even before that market comes, the herd comes.
Yeah, exactly. Yeah, so it's a little bit of an art and a little bit of a science, right? So what given our technology background and data background, one of the things we look at, we pull data from multiple sources. So some of them are public sources, some of them are subscriptions that we pay quite a bit of money for. But we look at trends that are taking place. Not to give away too many secrets, but there are other publications where you can see where certain industries are moving, where people are moving some of the headquarters. We even look at some data in terms of moving vans and trucks, like, what's the one-way traffic looking, is it a particular destination where they're all going, which gives an indication that people are moving to that area, right? So we look at that, and then those are just some initial identifiers. Then we start diving deeper into that market, understand what's going on. Often we fly down to the market, meet with the head of the economic development forum, or a similar organization, understand what their plans are. And we're not just looking for 2-year, 3-year type job growth. We're looking for 10 plus year job growth. And like, for example, in the Huntsville market, they did some recent studies where they have job projections into 2045, right? Nice. So that gives us a good basis. Again, nothing is guaranteed in this world, but it gives us a good baseline of understanding what's coming, understand, not just what other folks are investing, but what infrastructure the government is putting behind it to support these jobs and support the economy. And one of the main things, if you talk to quite a few of them, is in order to attract good employers, you need a good housing infrastructure. And that's where we come in and help, right? We can provide high quality housing at a affordable price at folks in this market, which, again, based on our market selection, we buy in markets that have a low cost of living. So when people move from DC or California or almost anywhere in the country, it's automatically a lot more affordable for them to be purchasing in this market than any other, which means that there's more room for rent growth, right? And with the current sort of climate that we're in, with the interest rates going high, et cetera, we want to make sure that we are buying properties that are cash flow positive day one, and that there's still some room for us to be able to increase the rents. Since some of your listeners may be aware, the way you control the value of a multifamily property, unlike single family, is by increasing the net operating income, right? So in single family, the value of the property is based on what the neighboring property is worth, or maybe the comps in a 1 or 2 mile area. Versus in multifamily, 2 identical properties right next to each other can be very differently valued if the net operating income of one of them is higher. So how do you increase the net operating income? You either increase the gross income coming in, which is rents, or you improve the efficiency or the operations to save some costs, right? And that all boils down to the net operating income, which is like your EBITDA. So we actually do both, and we also offer some additional services like high-speed internet, valet trash, some concierge service. It's like a virtual concierge type service that, again, people moving in from other markets like that type of service, right? It's an additional benefit they're getting, and it's at a slightly increased added to their rent, but because the rent is much lower than what they're used to, they don't mind paying for those additional services. So that model has worked for us, and that's generally how we increase the net operating income and the value of the property.
So are you all focused on Core Plus with I'm thinking with your amenities?
Yeah, no, that's a good. So initially, when we first started 7+ years ago, it was more value add, to be honest, right? Because at that time you could find those, and there's more opportunity for forced appreciation, where you can make some renovations and charge a higher rent. But then what we started to notice, especially during the pandemic, we almost had half our portfolio was, I'll call it workforce housing, and half of it was like the higher end B plus class properties. And during the pandemic, obviously, unfortunately, the people that got impacted the first or the most are people who had jobs in retail, hospitality, et cetera, which tend to be more in the workforce housing. And the folks who were able to work remotely and still continue to pay the rent were more in that B plus type housing. So we've shifted our focus a little bit more towards that higher end. We're not super luxury because we think that has some risk associated with it, and we don't want to be in a C-class property either because or deep value add because that has some risk. So we're in the middle, which is like a B plus class properties where we can still drive up the NOI, right? That's our key. We still need to be able to drive up the NOI. So as long as we have that and it's a stable renter base, right? That's what we're looking for. Along the way, we've also had some institutional investors JV with us. So they tend to like that type of asset class.
Got it. So that's a part of your capital stack is inviting institutional partners come in.
Depending on the size of the project, we have a couple, 50 million plus assets. So for those types of properties, you want somebody with a more dry powder.
Are you focusing on secondary markets versus your primary or even tertiary markets?
Yep, I'd say some of these markets like Huntsville, which has about 500,000 in the MSA, those are like a nice sweet spot for us. We like to be one step ahead of the institutional capital. The goal being, we can create a nice portfolio, and when the institutional folks start coming into that market and bring in a lot of capital, they're compressing the cap rates, the values go up, and ideally we could exit the entire portfolio to one of the larger institutional buyers. Again, no guarantee on that, but that's one option that you have, right? When with that play. If not, again, we could still sell individually. So we've actually started a fund to allow us to pick up some properties in these types of markets. We're also picking up some build-to-rent communities right now, straight from the builders. Again, the goal being let's create a portfolio, and the value of that portfolio will be larger than the individual homes.
Yeah, no, that makes total sense. That's a great play. That's have you all been affected by the insurance cost at all?
So in the markets that we're currently operating in, there hasn't been a huge drive up in insurance. Some of the markets that we were looking in, we had looked at some deals in Florida, and if we were still in Houston, for example, that would have hit us because insurance prices have drastically gone up. But in the markets that we currently operate in, insurance hasn't been as much of a factor. We do keep an eye on, again, like you said, insurance, property taxes, right? Things that are typically outside of an operator's control, even though you can try to appeal the taxes, etc. And that gets into our selection criteria as well. So we try to factor that in or stay away from, coastal properties that could see a big swing in insurance prices.
That's another huge advantage of getting in early. You can partner up with local municipalities and try to get some tax abatements for X amount of years to help the economic growth in those areas.
Yeah, it's getting more and more difficult to do that, I will say, but because everybody wants to, have a piece of that pie, right, and make sure that, and to be honest, some of the areas that we're in, they're seeing so much growth that they've had to put in additional infrastructure, additional schools, etc. So there's a cost for that, and that does have to get absorbed by the folks in that county.
Yep, totally true. Where are you at with the local market, debt markets, capital markets, and then what are your opinions going into next year?
Yep. So obviously, as everyone knows, the interest rates have gone up tremendously, even in the last, let's say, 18 months or so. And of course, that has an impact on the cost of the capital. The senior debt, which was typically and still is the cheapest debt you can get in your capital stack. That rate has gone up, and the other thing it impacts because of the DSCR or debt service coverage ratio is the amount of proceeds that you get. So what happens generally is, let's say 2 years ago, you could get up 75, 80% from the senior lender was not an issue. The remaining you could get with your LP equity. Now, the senior lenders are only going up to like 55, 60%, maybe 65%. So that means the remainder you have to fill with your LP equity, which is, in the grand scheme of things, the more expensive equity. And it also means you have to raise more, right? In an environment where people are afraid to invest. So it does pose some challenges. But we've been, knock on wood, we've been lucky so far. We've done a couple deals. We got agency debt, so we try to get a term that matches our business plan. So if a business plan is operated 3 to 5 years, we try to get something where you get either fixed debt for that amount of time, like 5 years, plus some options to extend it if needed. So the last deal we did was probably middle of the year. We got a 5.65 agency debt, which is not bad. We bought the property day one at a 6 cap, so it was cash flowing positive, and then we've increased the NOI from there. So you have to find the right property in this environment where that makes sense and can give you that positive cash flow. So I will say we underwrite just as many deals, or I'd say even more deals than we used to before. We're putting out more offers, but trying to get to that final price is still a challenge because the seller's expectation of the price is here, but in our estimation, it needs to be here, right? So that gap is narrowing, but we're not quite there yet. I think we're starting to get there, and with some of the loans coming up with their term, I think in the next quarter or so, we'll start seeing a lot of, let's say, the sellers being a little more receptive to the offers that we put out.
Yeah, I totally 100% agree. We're sending a lot of offers out as well. We just got a agency quote back on a property in 5, 7, and 10-year interest rates ranging from like 7.1 down to I think 6.89. So we're not sure whether we just get an extension on what we currently have or go ahead and refinance, because coming into next year, we could. UBS just repriced their markets for next year too. There's a lot of reports coming out. Everyone's, as far as interest rates, we're not sure whether see what happens or go ahead and take the guarantee.
Right. So we have a couple properties where we could potentially refinance or again, stay where we are. And it is and the market changes so fast, right? So the rate that might have been there earlier this week, it changes by the end of the week. And as you know, there's a series of things that need to happen. You also have to lock in a rate. So there are all these different variables and all these levers, I guess, that you get to pull and see. But so we're still waiting on those to say, okay, we're getting some quotes and some term sheets right now, and then we're going to make a decision probably in the January timeframe as to what looks the best. If you're asking about my personal opinion, I don't think it matters as much, but I do think maybe starting in the second half of 24, hopefully the rates will start coming down, or at the very least, people are already starting to factor in the fact that you're not going to see many rate increases, right? We may be flat or potentially one more rate increase, but so the market is already adjusting for that, and the rates haven't been as volatile as they were maybe 6 months ago.
Yeah, the Fed minutes just came out last week from the meeting 3 weeks ago, and there's even the forecast went down to 0 on any more rate increases. Right. So it's that's compelling. That's a good feeling. But then there's also, it's like the what if scenario out there too.
Yeah, there's definitely a lot of different moving parts in the multifamily market right now, right? And as we said, it's what's going to happen with the Fed and the rates there, but also how many properties are going to start coming on the market because of other factors that may force the sponsors to sell, etc. So, we're waiting for that. We've heard that there's a lot of dry powder on the sidelines from the large players waiting to snatch up some of these deals. We're starting to see a couple of those. The one good thing about focusing on a couple smaller markets is that we have very good relations with not just the brokers, but the government officials, other businesses in the area. So we get to see a lot of off-market deals.
That's awesome.
And because of that, we get visibility to certain deals that maybe the sellers don't want to publicize, right? So again, there's still that a little bit of disconnect, I think, in the pricing right now, but that might change, I think, over the next quarter or so, and that's why we started our fund. We have a $50 million fund where we're keeping some dry powder available to be able to snatch up some of these assets at the right time.
Nice. Are you all focusing on family offices, retail investors? What?
All of the above, right? But it's 506C, so it's a accredited investor based fund. Majority of the investors, I would say, are just a typical high net worth type individual, and by high net worth it means accredited investor, right? And so it could be anywhere from we have quite a few doctors, dentists, just technology folks with high paying W2s. It spans the gamut. We do have a couple of family offices, some RIAs. We're planning to. We're actually going through an exercise right now of fine tuning our, we call it our investor avatar right now, and trying to create some more targeted messages for each. So we'll be doing some of that in the coming weeks.
Are you all seeing any tightening as far as capital coming in on your all's raises?
Yeah, I mean, it's like I mentioned earlier, it is a little more challenging, I think, to bring in capital these days. We've been fairly lucky. We have a growing set of investors that have invested with us, over the last 7+ years. So we have a nice pool of investors, but we always want to continue to add to that, have that dry powder. And what I realized over the last couple of years is investing, even though you may view it as very logical, and given our sort of tech analytical background, we view it as, hey, this is a great time to buy these assets when they go down. The reality is that the investor, it's still an emotional decision for the investor. So logically, yeah, that might make sense, but for somebody to write out a check, it's still a little bit of an emotional decision, right? Not for the non large institutional type investor. So we do see a little bit of that. People are sitting on the sidelines, but we've been fortunate where when we have the deal, we've been able to bring in the investors that we need. So we hope that will continue. We hope we continue to come across some good deals and present those opportunities to our investors. And we always give our existing investors the right of first refusal, if you will. We bring it to them before we bring it to anybody else. We say, hey, here's what we have. Maybe it's similar to another project we have done. Maybe it's different. Let them invest first, and then we open it up to the others. So we maintain a list of folks where if they're interested, they can reach out to us. We'll put them on this sort of waiting list. And then as opportunities present themselves, we'll bring in more investors.
How are you all structuring the deals? Are you offering pref and then maybe limited upside, or no pref and then bigger split?
So we if you ask me, so I guess I should first also state we invest in all our deals, right? And when we invest our own capital, this is on top of the promote, etc. We do it at the same level as the LPs, right? So the first thing we do is show sort of alignment with the LP investors that, hey, we're putting our own money in. In many cases, we're the largest investors in the deal. And the way we structure it, and it's very, the terms, if you ask me, are pretty investor friendly in the sense that we don't charge a lot in terms of fees. We do charge an acquisition fee, but that ranges between 1% and 2% depending on the size of the asset. And then that's really it. We don't charge financing fee. We don't charge refinancing fee. We don't charge a disposition fee. And maybe we should have been, but we don't charge all those fees. We'd rather get our sort of make wealth along with our investors. So we what we do is we have most of our deals when we've done syndications. So we did about 9 or 10 syndications where we had on average about an 8% pref and then a 70-30 split. Some were a little different based on the nature of the project. But in the fund, what we're doing is that we actually decided to make it even more friendly. So we put an 8% pref and an 80-20 split,
Wow.
which honestly, I haven't seen anybody do in on the real estate side. Part of it was just the environment that we're in, but the other part of it was, look, this is our second. It's called PC Fund 2, but this is not going to be the last fund that we do, right? Our goal is to continue to grow from here. So let's just uh, be share some of our profits with the investors who have been loyal to us. And as we started to talk to some of the larger family offices and stuff, that attracted them a little bit more. So we'd rather have the dry powder available now because we think we can get better deals for everyone and everyone wins. And so we don't mind giving up some of our upside for that. And so we've structured it as an 8% pref and an 80-20 split right now.
That's bold. It's definitely bold. As long as I think that the asset, the business plan matters a ton. If it's a value add and it's I'm not going to say a heavy lift because you're not going to see those in funds, but a medium, right. You're cosmetic, putting lipstick on the property, which still requires effort. You're going through evictions or forcing move outs, and then you're releasing it up. I mean, there's a lot of effort and time that can be put into that. So I guess as long as it's balanced where the GP is paid accordingly to where everyone feels like their time has been compensated for, it works.
Right. No, and you're right. And I think the way we have structured it, I should say there is a 2% management fee in the fund, right? So there is some compensation that we get, but that barely covers a person, right? So it's we're okay with deferring our compensation for the later because we have a long-term vision in mind, so we don't mind saying, hey, look, we'll align our compensation to how we view the business, and we don't mind if we get paid 3 years, 5 years out, because we have the longer term vision in mind.
Yeah, and as long as you're able to get something along the way, you all have the overhead, you all have true cost of people out and make the things work. So,
I should also say we are vertically integrated, so we have our own property management functions.
That was my next question.
Yeah, we have about 22, 23 people. So for them, of course, that is part of the property management fees, right? So that supports them. But even with that, there are people in the back office. Like I don't get charged to that. There are other folks who don't get charged to that. They may be part of let's say an accounting person or finance person that gets charged, but there's still overhead with that, right? So there's. So I guess if for anybody who's on the LP side and wants to get onto the GP side, just think about that quite a bit and make sure that, because initially people look at it and say, oh, the GP is making X amount, whatever in 3-5 years. But along the way, you gotta pick up, you gotta pay everybody's salary, you gotta pay all these this overhead you have. We have an office, so it's a business, and you almost have to treat it like a startup business where you're not going to really see a lot for the first couple of years. But then hopefully if the deals are right and you've been executing properly, you'll get some payoff, but it'll be further down the road, right? So the cash flow is pretty choppy, and people, especially if they are accustomed to a W-2 job, forget about getting paid every week or 2 weeks. That's right. I would say you should be able to maintain your lifestyle for a couple of years without having any income coming in.
Well, you're finding the deals, you're procuring the deals, you're signing on the debt, you're protecting capital, you're executing the business plan, and ultimately responsible for the outcome. So if you've done all those things, the compensation that is deferred for years, that's very well earned. And
right. And trust me, that's something that you don't get a full appreciation for until you're on that sponsor side. So for anybody and like I said, our fees are very, very low, if you ask me. So anybody, sometimes we get the question, oh, why do you have equity? I'm like, hey, you're welcome to go find the deal, operate the deal, do everything that we're doing, and I'm happy to pay you. I'll even pay you the 70-30 split. That seems fair to me. Would you like to do everything that we're doing? And provide the same type of results based on our, and in our case, I'll jump over to the LP side.
Well, and when you've got a true operator that's managing a fund, that's doing real estate, it's apples and oranges compared to like a hedge fund on Wall Street that's deploying capital and essentially putting their hands in the air, and the operator's doing all the work. So your fees are truly nominal compared to how much effort and work goes in the back end. And being vertically integrated, that is the only way to go. You've got control over how hard you can push the business plan and execute, and communication and renovation teams. I mean, that's a huge advantage, and being able to control the entire cycle.
No, we agree with you. In fact, so when we first started, we were using third-party property managers, and then as your portfolio grows, just for all the reasons you mentioned, right? Better communication, better control, or instead of having just influence on what happens at the property, more direct control. But I think one of the other larger things was to get a unified view across your portfolio. What we were saying is, one property manager or even the same property management company, at one property may have one chart of accounts, another property they had a slightly different chart of accounts. Yeah. And we were trying to pool everything together to get a portfolio-centric view, and it was almost impossible, or it didn't quite line up. So that's really what led us to say, okay, you know what, we just need one chart of accounts, and we use that across all our properties. It took some time to get that. We have a standard set of operating procedures, and so we can have more consistency across our portfolio and make decisions at a portfolio-centric view. I'm not saying it's perfect, but it's a lot better than what it used to be, right? And
you've got property management. That's a separate company. They've got their own set of bills. You've got the GP syndication company. You've got all these companies that need to be propped up off of the back of the property. Eliminate that whole side, and then now you've got a blended overhead. I mean, it helps a ton. It does, and ultimately, the ones who win are the investors at the end of the day. It's just
our whole goal, everything we do. So even another example I'll use in a typical property manager. I mean, even if they've been in the business 20 years, 30 years, they view it as, hey, I'm doing well if my occupancy is good, right? Or my debt, delinquency is low. And yes, those are important things. However, they're not necessarily looking at, hey, you know what, I can save $1,000 on this landscaping contract a month.
Yeah.
Well, it's not just $1,000 saving. It's $1,000 a month plus 12, right? So that's 12,000, and then based on the cap rate, let's say you use a cap rate of 5, that's like a 20x multiple that you have to apply. Yeah. So at $12,000 savings a year times 20, right? So was that 240,000 plus times you're holding the property for 5 years? That's like $1 million. Yeah. Right there. So it's that mindset shift that only comes from a owner. And so every decision we make, even in renovations, et cetera, we're constantly looking at what is the return on this, right? Not just in the immediate, hey, I'm getting $10 more per month, but what is the result to the value of the property over the next 3 years, 5 years, or whatever the business plan is.
Yeah, that's huge. And just control of expenses. That's another huge advantage. Very cool. If you're a beginner just starting out in real estate and you know now what you wish you knew then, right? What changes would have you made, and then what lessons would you, I guess, avoid that you've made?
Yeah, good question. So I guess it depends on where people are in their journey and what they're comfortable with. And what I mean by that is, for some reason, when everybody starts out, including myself when I first started, right? When you say, hey, people I think know, okay, they would like to get into real estate. The one obvious thing that comes to mind is rentals. The first thing that comes to mind with rentals is single family, right? Because when I think I started to invest in single family like in 2000, actually before 2000 even. So long time ago. And they, at that time you start to, again, operate it, and then you quickly find out it's hard to scale that, right? So my advice would be look at what is your long-term vision. If you need to start out with single family, great, but you don't necessarily have to. If you really want to scale and expand your sort of real estate portfolio, then you should look at multifamily. There are other asset classes you can also look at. We did that sort of analysis, and multifamily made the most sense for us. But look at other asset classes, and then the next decision is taking on a property, so initially I just wanted to buy, let's say, a 50 unit property by myself, but then you start looking at the numbers and you underwrite it, and those types of properties cannot support a full-time leasing person, cannot support a full-time maintenance person, and that starts to have an impact on the occupancy. So you look at it saying, okay, to operate this business the way I want to, what is the minimum number of units you need? And for us, it's somewhere between 85 to 100 units, depending on the market. So you say, okay, if I'm gonna buy 100 units, do I have the ability to buy it myself? Is it 1, 2, how many can I buy? Or do I need to start bringing in others, right, to join me? So just lay out that entire plan. I will say right now it is challenging if you're trying to raise capital. It's always challenging to raise capital your first time. I tell folks who start, even if the environment was conducive to raising capital, if you think you can raise $2 million, count on $1 million, right?
Yeah.
So in this environment, it's even more challenging. However, I think there are some opportunities there that you will start to see. So if you have the ability to capitalize on that, do that. If not, try to partner with somebody who has an established track record, or you definitely have to bring some value, right? You can't just be a capital raiser in that group. There are some laws against it, so make sure you understand what the SEC requirements are. But let's say you truly can add some value as part of that sponsor team, or JV with them, or do a fund of funds. Then I think there's some silver lining on these clouds to be able to pick up some good assets in the next 6 months to a year. So that's what we're focusing on, and then just over time, you gradually start to augment the business and start to grow. When you hit a certain threshold, usually around 1,000 units, you can start looking at being vertically integrated. After that, you can look at doing your own sort of insurance. There are things that you can do that'll add value to your portfolio as well as to the investors. So there's the good news about real estate is there's so many different ways to invest in it and improve operations. The bad news about real estate is there's so many different ways of doing things that you have to assess all of them and make sure you select the right one for where you are in that journey and what suits your strengths and weaknesses the best.
Yeah, that's perfect. What books would you recommend someone to go out and read if they're getting started?
That's a good question. I mean, there's a number of books out there. There's some good ones. Brian Burke has one if you're trying to be an LP investor, and I think it's like hands-off investing or something. Look up Brian Burke and his book. If you're trying to get into syndications, there's a number of other books out there. Joe Fairless has a couple. And then if you're just starting getting into real estate, you want to understand the tax environment. Tom Wheelwright has a couple of books, right, from Rich Dad, Poor Dad sort of series. So I would recommend those. And then for anybody who's just starting their sort of real estate company, there are frameworks that can help you, like EOS or Entrepreneurial Operating Systems, Attraction by Gino. That's a good book. They just came up with a new one called Process. So there's a number of, there's no shortage of resources out there. There are also a lot of good podcasts out there I would recommend. If you're just starting out, go to Bigger Pockets. That's a huge resource. We've been part of that for 12 plus years, I guess now. So a lot of things out there, but the challenge is going to be narrowing down where to focus, right? I always listen to all these audiobooks and stuff, even on my drive to work or whatever. That's a good way to stay current.
Yeah, there's like no TV time.
Right.
Any free time is but you named off a lot of those are staple books, and they're great books. They're leveling yourself up.
Yeah, the reason they're well known, and I guess they're popular. There's some more esoteric stuff that I read, but it's more I don't know if it's I directly related to real estate investing. Is just more general business and things of that nature.
Yeah, awesome. Very cool. If somebody wants to reach out, get a hold of you, find out more about your company, how can they reach out?
Yeah, you can go to our website, which is Penn Capital Group. That's PennCapitalGroup.com. Or look us up or look me up on LinkedIn. You can connect through there as well. Also on Bigger Pockets. So any of those ways are fine.
Very cool. Definitely appreciate your time. Look forward to following you, and enjoy the rest of your weekend after this Thanksgiving holiday.
Yep, you too, Josh. Thank